Welcome to the Dup Dive. Today, we are undertaking one of the most intellectually complex, high-stakes investment cases currently orbiting the public markets. AST SpaceMobile, Inc., ticker ASTS.
It's a fascinating one. Really sits at the intersection of aerospace, telecom, and pure venture capital, but all wrapped up in a public company.
At its core, the proposition is just audacious. It's the potential cell tower in the sky. Their engineering mission is to dismantle the century-old limitations of terrestrial connectivity.
And they plan to do that by transforming, what, 5 billion standard smartphones in the world into satellite phones?
Exactly, with zero hardware modifications, zero special apps, and zero user friction. If they can actually pull this off, the scope of disruption is truly staggering.
And that technological ambition, coupled with the, let's say, the profound financial structure, is exactly why this company is such a difficult animal to value. I mean, we're looking at a pre-profit aerospace enterprise, a pure builder of infrastructure that already commands a market capitalization of $21 billion.
It's the quintessential modern story stock, isn't it? But its success relies entirely on, well, complex physics and just flawless execution.
Absolutely. And that's why we applied the rigorous principles of classic value investing, the Buffett test, so to speak, to this very futuristic technology play. We scrutinized the competitive moat, the management alignment, and, of course, the capital structure.
And the conclusion you came to?
Well, the conclusion we arrived at is that this is an intensely asymmetric bet. If the company achieves global utility status, we project a massive 5x potential upside. However, if they face technical failure or protracted execution delays, the downside risk is a swift and significant 45% or more from current levels.
Wow. So a huge potential reward, but with very real, very significant risk.
Exactly. This deep dive is designed to show you precisely where that tightrope walk occurs.
Our mission today is to move past the hype. We will extract the intrinsic value, define the true competitive moat, evaluate management competence against an aggressive timeline, and scrutinize the capital efficiency from the considerable source material you've provided.
Yet we're here to give you the shortcut to being well-informed on this pivotal company.
Okay, let's unpack this. We are starting now with Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
Okay, so to really appreciate the scale of the solution ASTS is building, we have to first deeply understand the scale and the nature of the foundational problem it addresses.
And the problem, as the sources define it, is known as the cellular density trap. This isn't just a commercial challenge. It's a structural failure that's baked right into the economics of our terrestrial networks.
Absolutely. Terrestrial networks are ruled by a simple inverse relationship. High population density yields high coverage, while low density, well, it yields zero coverage.
And the sources quantified this with the unit economics, right?
They did. Building a standard cell tower requires about, say, $200,000 to $300,000 in capital expenditure, or CapEx.
And that model works beautifully in dense urban environments. You place a $300,000 tower in a city, and that cost is absorbed pretty quickly by thousands of daily users. That leads to a high return on invested capital, a great ROIC.
But the moment you move into rural landscapes, maritime shipping lanes, remote deserts, or even just national parks, which, by the way, comprise nearly 90% of the Earth's surface, that economic model completely collapses.
It just doesn't make sense to spend $250,000 to serve, what, a few dozen people?
Precisely. The ROIC will always be negative. And this coverage gap isn't just an inconvenience. It's a humanitarian and economic failure. We are talking about 750 million people globally who lack access to mobile broadband coverage.
And that's not even counting the rest of us, the 5 billion global mobile subscribers who are constantly hitting dead zones just by leaving the highway or stepping indoors in a remote area.
Exactly. The structural constraint means traditional carriers will never build infrastructure in those areas.
And if we look back at history, every prior attempt to solve this, I'm thinking Iridium, Globalstar, Inmarsat, they all failed. And it wasn't because the physics didn't work.
No, it was because they violated the cardinal rule of consumer technology.
Yeah.
Eliminate friction. They required users to buy proprietary, bulky, and really expensive satellite phones. You had to change your handset and your behavior.
Which nobody wants to do.
Nobody. Which brings us to the core innovation of ASTS, the direct-to-device, or DTD solution, which just flips that entire paradigm on its head.
So they shift all the operational, technical, and power complexity from the user's hand to the satellite up in low Earth orbit.
For the user, it's seamless. For the engineer, it's a miracle of physics.
Okay, let's get into that physics, because this is the single most critical differentiator that validates the market's high valuation. This all comes down to the scale of the satellite aperture, specifically the forthcoming commercial Bluebird 6.
Right. So the prototype, Blue Walker 3, it proved the concept worked.
Yeah.
But the scale required for high-speed broadband is just, it's enormous. The Bluebird 6 features a commercial phased array antenna measuring nearly 2,400 square feet.
Wow. 2,400 square feet. Just to put that immense scale in perspective for you, that is larger than many urban apartments. It's bigger than the wing area of a commercial jumbo jet.
It is. And the reason it needs to be that massive is fundamentally about overcoming the distance and power differential.
Yeah.
We have to consider two sides of the coin, uplink sensitivity and downlink power.
Okay, let's start with the uplink.
So a standard smartphone transmits at extremely low power. We're talking under 200 milliwatts. Trying to pick up that faint whisper of a signal from 700 kilometers away.
That requires massive antenna gain.
It requires colossal antenna gain. I mean, we can think about this in the context of the Freeze transmission equation, which dictates that signal strength drops off exponentially with distance. To compensate for that 700-kilometer path loss, the receiving antenna on the satellite has to be that big just to pull the signal out of the noise floor.
And that's the physics hurdle. It explains why competitors using smaller satellites, like Starlink in its current iteration, simply can't close this high-bandwidth data link. They can't overcome that massive path loss.
Which is why they're currently relegated to focusing on basic SMS or maybe emergency voice only. Those services require exponentially less data throughput. ASTS is targeting the real high-value broadband data market.
And the other side of that coin you mentioned, the downlink power, that's just as crucial.
Oh, absolutely. The massive array doesn't just receive well. Its capability to form tight, high-power beams is essential for penetrating dense obstacles. Things like foliage, vehicles, and even the internal structures of buildings.
Ah, so that gets you indoor coverage.
That is the key. Without that power, you do not achieve critical indoor coverage. And that is the definitive difference between being an emergency service and being a true utility provider. Winning the value game means providing consistent indoor broadband.
But the technology, however revolutionary, would be worthless if they couldn't access the necessary radio waves. And that brings us to the spectrum strategy, which the sources rightly label the Trojan horse.
This strategy is brilliant in its simplicity and, more importantly, its financial implications. Look, legacy satellite operators bankrupted themselves spending billions in competitive auctions to acquire dedicated spectrum licenses.
A huge upfront cost.
Billions in upfront capex. ASTS avoids all of that by utilizing the existing, already licensed spectrum of its mobile network operator or MNO partners.
So they just tune the radios on the Bluebird satellites to the standard low-band cellular frequencies 700 megahertz, 800 megahertz, 850 megahertz that their partners, like AT&T and Vodafone, already own and use on the ground.
Yes. And this is the regulatory arbitrage that creates an instant deep moat. They are leveraging the FCC's specific supplemental coverage from space framework, the SCS framework.
And that framework explicitly permits terrestrial spectrum to be used from orbit as long as it stays within the guardrails of the MNO's existing license.
Correct. So the SCS framework isn't just a regulatory term, it's a profound financial weapon. By using their partners' pre-licensed airwaves, ASTS bypasses the need for those costly spectrum auctions.
And crucially, it effectively locks out any competitor, domestic or international, who doesn't already have deep strategic MNO partnerships that grant them access to that spectrum.
It creates a competitive fortress built on regulation and partnership, not just on technology.
Which leads us directly into the business model. It's a wholesale model structured for what look like extraordinarily high margin.
Right, the business to consumer or B2B2C model. The efficiency here is just staggering.
Because the MNO partners, AT&T, Verizon, Vodafone, they own the customer relationship, the billing, the marketing, the support.
ASTS faces effectively zero customer acquisition costs, or CAC. They are purely a wholesale infrastructure provider of satellite capacity. It's a beautiful, clean model.
So what does the revenue structure look like?
The standard agreement is a 50-50 revenue split on value-added services, the main one being roaming features like day passes. The MNO offers a massive service upgrade, guaranteed 100% coverage, and ASTS captures high-margin, predictable wholesale revenue that scales exponentially as they deploy the constellation.
And the analysis protocol highlights the crucial role of high switching costs here in cementing that competitive moat.
Yes, this is a really important point. Once an MNO integrates the ASTS system to guarantee that 100% continuous coverage, removing that capability would immediately and severely degrade their service quality relative to competitors.
They'd be at a huge
It's
disadvantage.
a huge one. This locks the MNOs into a long-term strategic reliance on ASTS capacity, creating deep stickiness. It's very, very hard to rip out.
You know, if we connect this back to the bigger picture for investors, the fundamental business model is actually structurally recognizable to value investors.
It really is. It's essentially a cell tower leasing business, much like an American tower or a Crown Castle, but with a radically improved global coverage profile and vastly reduced maintenance capex once the constellation is up.
And that utility-like structure is what justifies modeling those robust future cash flows, even if the physics of getting there is a little mind-bending.
Right. The how is complex, but the what is a business model investors can understand.
Now that we understand the engineering marvel and the financial advantages of the business model, we have to look inward. Can the management team actually execute this extraordinarily ambitious vision? That kind of execution requires a rare blend of, well, fanaticism and financial discipline. Chapter 2. Management evaluation.
Yeah. When you're analyzing a high-stakes, pre-profit aerospace venture like this, the integrity and the capability of the management are arguably the most important variables. The sources paint the founder, Abel Avellan, as a fanatic.
Which is a quality you often see as necessary to achieve world-changing scale, isn't it?
It often is. And the alignment with shareholder interests, at least on paper, is textbook. The most cited detail is Avellan's decision to take zero salary for multiple years.
So his entire personal compensation is tied purely to stock appreciation. He only wins if the common shareholder wins.
That commitment defines the owner-operator culture that investors typically seek out. It's a huge green flag.
However, we need to introduce some critical tension here, as any sophisticated investor must. We have to weigh this against a governance structure.
Right. Avellan's personal alignment is strong, but the voting control red flag has to be acknowledged. This company operates with a dual-class share structure.
Which means
It means that while common shareholders hold the vast majority of the economic value, they hold little to no voting power.
that's the potential contradiction we need to examine. Wait a minute. If the company requires massive long-term capital investment, and the founder holds little of his personal wealth in liquid assets outside the stock, given that zero salary, doesn't that create a massive systemic incentive for short-term, over-optimistic guidance just to keep the stock price high enough for future dilution events?
That is precisely the question critical investors have to ask. While there are no egregious related party transactions flagged in the source material, that dual-class structure is a perpetual risk.
So he has the ability to dictate major strategic decisions, like the timing and pricing of dilution, without needing consent from the public shareholders.
Exactly. This structure requires constant investor monitoring, and it really acts as a structural discount on the overall valuation.
And speaking of guidance, we have to discuss historical credibility. The company has faced past shareholder class action lawsuits related to the delay of the Block 1 satellites. These issues, while common in early-stage aerospace, they do illustrate a pattern.
Yes, and the lesson for the learner is crucial here. Management has a history of over-optimistic guidance and missing aggressive timelines. In aerospace, where launch windows and component testing often slip, investors absolutely must build in a significant delay buffer into their financial models.
So if management promises Q1, a prudent investor should probably model that revenue for H1. If they project end-of-year completion for a constellation milestone, you should interpret that as next year.
That recalibration is essential for managing capital requirements and accurately forecasting the cash burn rate. It's just a matter of prudence.
Yet the most powerful counterbalance to these governance and credibility concerns is the institutional validation built into the management bench and the board itself. We see executives from major partners like AT&T, Vodafone, and American Tower holding advisory or director roles.
And let's be clear about who these people are. These aren't just polite ceremonial appointments. They represent companies that have committed hundreds of millions, if not billions of dollars to this project.
The presence of, say, the former head of network integration from AT&T, that validates the practical integration pathway. They've looked under the hood.
It acts as an invaluable due diligence proxy for the retail investor. These executives represent fierce rivals who have put aside their differences, signed commercial agreements, and placed their own leadership into the company's structure. That implies their internal engineering teams have thoroughly audited and validated the technology's viability and the aggressive manufacturing ramp plan we'll discuss later.
So if they trust Avellan with their network's future, that provides a significant amount of confidence.
It does. So the management story, therefore, is one of extraordinary alignment and external validation, but with a necessary asterisk next to governance and execution timing. That duality makes the financial analysis even more critical.
Chapter 3. Financial health.
Okay, now we confront the financial paradox head-on. How does a company with minimal commercial revenue command a $21 billion market capitalization? The financial health has to be assessed not on current performance, but on its capacity to survive long enough to realize its future utility value.
If we looked at the income statement forensics for Q3 2025, the picture is classic pre-profit. Revenue was a mere $14.7 million. And while this was up 1,236% year over year, it is mathematically negligible for a company trading at this valuation.
That revenue is what the sources correctly label proof-of-life revenue. It derives mostly from achieving specific government milestones and engineering targets under existing contracts. It's not from large-scale commercial subscriber revenue from MNO partners.
So it proves the work is progressing, but it doesn't prove the business model is viable yet.
Not at scale, no. And unsurprisingly, the net loss is steep, $122.9 million. The losses are intentionally widening because the company is in the acceleration phase of its manufacturing ramp, consuming massive amounts of capital to build the required constellation.
Let's analyze those operating expenses, which totaled $94.4 million for the quarter. You have to distinguish between good and bad expenses here.
That's right. A vast majority is allocated to research and development, R&D, and engineering services. This is good expense. It's essentially CapEx disguised as OpEx, directly creating the asset, the moat, that will yield future returns.
However, we do have to monitor the rise in general and administrative, or G&A, expenses. As the company scales this rapidly, there is an inherent risk of organizational bloat.
That's the danger. Hiring too quickly, increasing executive compensation, inefficient overhead. Sophisticated investors must track this G&A trend quarter over quarter. If G&A starts outpacing R&D growth, it signals a lack of capital efficiency and potential misalignment.
But the single overriding factor insulating the enterprise from failure is the balance sheet liquidity. This is the financial survival bridge.
It's the whole ball game right now. The war chest is massive and absolutely critical. $3.2 billion in pro forma cash and available liquidity secured over the course of 2025.
In the current macroeconomic environment, with the 10-year Treasury sitting around 4.09%, capital is not cheap. That $3.2 billion fortress insulates the company from the need to secure high-interest debt or face predatory capital markets for at least 24 months.
It allows them to pursue the aggressive construction timeline unhindered, regardless of short-term market volatility or delays.
But securing that fortress came at a significant cost, didn't it? Shareholder dilution.
Yes. The analysis shows the share count is up approximately 76% year over year due to capital raises. And that is painful for early investors, no question.
But you have to analyze this as a fundamentally rational capital allocation decision, right?
You do. Management chose to sell equity at highly appreciated prices, often well above $50 per share, specifically to fund necessary CapEx and de-risk the enterprise's survival. In this high-stakes venture, the cost of failure is absolute, whereas the cost of dilution is survivable, especially if the subsequent returns are 5x to 10x.
Survival is the priority.
It has to be.
So we have a healthy balance sheet, a non-commercial income statement, and a $21 billion market cap. Traditional valuation metrics are useless. We are forced to look far into the future, which necessitates a discounted cash flow, or DCF, model based on the company reaching its mature utility state.
This exercise is crucial for defining the asymmetric risk. We have to assume the technical risk is solved, and the company becomes the global infrastructure provider it aspires to be. Let's start with scenario A, the bull case, where they succeed in becoming the global roaming utility.
Okay, so for the bull case, we assume global continuous coverage by 2028, and we model the company capturing, 10% of the 5 billion global mobile subscribers?
Yeah.
So 500 million roaming subscribers using the service periodically.
Right. And if ASTS as a wholesaler captures an average revenue per user, an ARPU, of just $2 per month from their 50-50 revenue split, that results in an astonishing $12 billion in annual revenue at maturity.
And the margin justification is key here. Once the satellites are built and launched, the operational costs are extremely low. So we're modeling a high operational leverage.
Exactly. Yielding a 60% margin, which is pretty standard for robust, high barrier to entry infrastructure assets. That means $7.2 billion in annual EBITDA.
So if you apply a 15x multiple, a reasonable figure for essential high-mode infrastructure or a telecom utility, what does that scenario give you?
It results in an enterprise value of $108 billion.
108 billion. That is the core of the potential reward. From the current $21 billion valuation, that projection represents a 5x return potential over the next 5 to 7 years.
Now let's pivot to scenario B, the bear case. This is where execution stumbles or maybe Starlink successfully commoditizes the basic service, relegating ASTS to more of a niche role.
In this scenario, we assume ASTS captures only the highest-end enterprise, defense, and maritime customers, so a much smaller subscriber base, maybe 20 million users.
Correct. But because this is a specialized premium data service, we model a higher ARPU of $10 per month. That yields $2.4 billion in annual revenue.
And assuming continued high operational efficiency, what kind of EBITDA are we looking at?
About $1.2 billion in EBITDA, but we'd apply a more conservative 10x multiple, reflecting the niche market and the higher perceived execution risk.
Which gives us an enterprise value of
It's $12 billion.
So the implication of the bear case is clear, a swift 45% downside from the current market capitalization.
It confirms that the current $21 billion market price is paying entirely for growth, success, and the probability-weighted outcome leaning heavily toward the bull case. There's simply no traditional deep value margin of safety here based on current assets or liquidation value.
If you are looking for an undervalued asset, this isn't it. You should look elsewhere. This is pure speculative positioning on the successful execution of an aggressive technological roadmap.
And that leads us perfectly into the external environment, the competition, and the risks that define that very roadmap.
Before we move on to the second half of our deep dive, just a quick message. Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Stick with us as we shift from the internal financial state to the external market dynamics and the competitive landscape. We are continuing now with Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Let's start with Market Validation. Chapter 4, Market Sentiment.
The market sentiment surrounding ASTS is overwhelmingly driven by the validation provided by its strategic ecosystem, the MNO Alliance. This network of fierce rivals signing on is really the clearest bullish signal possible that the technology works and is essential.
The standardization implied by this MNO alliance is perhaps the strongest piece of evidence we have. I mean, AT&T and Verizon are fierce generational competitors in the U.S. market. They spend billions fighting each other for supremacy, yet both have invested in and signed commercial agreements with AST SpaceMobile.
Which signifies they see ASTS not as just another vendor, but as a mandatory standardized layer of infrastructure necessary for their future competitiveness.
Right. If AT&T rolls this out, Verizon has to follow. It creates a powerful network effect in the U.S. market that just reinforces the ASTS moat.
And the global reach is massive. You have Vodafone and Rakuten providing crucial gateways to Europe and Asia. The sources even mention that the Vodafone partnership is specifically linked to the European IRS-2 Sovereign Constellation project,
which opens the door to potential European Union government funding and further regulatory standardization across the entire continent.
Yep. And we also have to give weight to Google's strategic investment. This isn't just a financial play. It suggests a long-term goal of integrating satellite connectivity at the fundamental Android operating system kernel level.
Wow. So if Android phones can just connect to ASTS seamlessly, without any special user action or even awareness,
it eliminates the absolute last shred of user friction and ensures deep adoption across billions of handsets. It becomes a default feature.
Okay, now let's address the formidable competitive threat. The elephant in the yellow room. Elon Musk's Starlink SpaceX partnered with T-Mobile. They are pursuing their own direct-to-cell initiative.
This is the crux of the competitive analysis. We call it the physics war. As we established, the key differentiation lies in the physical capability of the satellites. As of late 2025, Starlink's smaller satellites primarily offer SMS and maybe emergency voice.
Whereas ASTS, with its massive 2,400 square foot antenna array, is positioned to win the value game for true high-speed broadband data transmission.
The consumer wants to stream, send photos, use apps, which requires bandwidth that only the large aperture satellites can currently deliver from LEO to a standard low-power smartphone.
And there's another advantage for ASTS, right, on the regulatory side.
A subtle but powerful one. SpaceX and their terrestrial partners are currently mired in regulatory disputes, primarily concerning out-of-band emissions, or OOBE.
That's the potential for their satellite transmissions to interfere with adjacent spectrum users.
Correct. SpaceX needs regulatory waivers and modifications to operate fully. In stark contrast, ASTS operates on its partner's pre-licensed spectrum under the FCC's clear supplemental coverage from space, the SCS framework.
So they have a clean, compliant regulatory path. That reduces a massive source of political and operational risk, giving ASTS a stability advantage that Starlink may struggle to overcome quickly.
And finally, we cannot overlook the sleeping giant of government and defense revenue, which provides a critical revenue floor for that bear case scenario we talked about.
The potential for dual-use technology here is immense, isn't it? The U.S. Department of Defense requires resilient global communications that don't rely on bulky proprietary equipment.
If a soldier's standard handset can connect seamlessly, the technology becomes strategically invaluable in contested or low infrastructure environments.
And crucially, the AT&T partnership already includes integration with FirstNet. That's the U.S. public safety network dedicated to first responders.
Which means ASTS is effectively slated to become critical national infrastructure. This government-backed revenue provides a stable, high-margin floor that significantly mitigates the risk of the total collapse implied by the purest bear case.
It transitions the company from being a purely speculative consumer play to a foundational national utility with guaranteed revenue streams, a huge de-risking factor. Chapter 5, Ownership Structure.
When analyzing a high-growth company with this kind of binary risk, the quality of the institutional ownership profile, the cap table, provides critical validation that retail investors just can't replicate on their own.
Let's review the quality of the strategic holders. These aren't passive, quick money investors. These are companies whose futures are directly tied to the success of ASTS.
Let's detail the skin in the game. Rakuten Group holds approximately 31 million shares, valued at around $1.7 billion. Alphabet, Google's parent, holds nearly 9 million shares, valued at $500 million. And AT&T holds over 6 million shares.
These are substantial, long-term investments that validate the technology, the business plan, and the execution risk profile.
And we also see passive validation, the inclusion in major index funds. Massive passive funds like Vanguard hold nearly 20 million shares, and BlackRock holds over 10 million shares.
Which signifies inclusion in major indices and ETF baskets, providing liquidity and further stability in the stock price.
Right. And this high-quality strategic ownership implies two potential benefits for you as a learner. First, these investors are highly unlikely to panic sell on minor delays, which stabilizes the stock.
And second,
their large stakes make ASTS a highly attractive target for M&A, potentially driven by one of these strategic partners looking to secure control of the infrastructure long-term.
that's a good point. However, we have to briefly link this back to the dual-class structure we noted in Chapter 2.
Yes. Despite this immense pool of institutional and strategic capital, the common shareholders, including these massive passive funds, still hold little voting control. The founder's vision, right or wrong, ultimately dictates the path forward.
Which just reinforces the need for continuous oversight and the risk premium associated with that type of governance. Chapter 6, Risk Assessment.
We've established that this is a highly volatile, binary investment. The risks are existential, and they fall into three distinct categories: the immediate operational catalyst, execution and timeline risks, and macroeconomic headwinds.
The immediate operational risk is crystallized into one single non-negotiable event: the scheduled launch of the Bluebird 6 satellite on December 15, 2025.
The importance of this date cannot be overstated. This is not another prototype test. This is the industrialization of the Block 2 architecture. Successful deployment and validation of this satellite retire the fundamental technical risk.
It answers the question of whether the 2,400 square foot antenna can survive launch, deploy correctly, and function commercially in LEO.
It's the binary moment. If the launch is successful, the technical risk is largely retired, and the market can begin pricing in revenue certainty. Failure, whether it's a rocket anomaly, a deployment malfunction, or a satellite failure post-deployment, would be catastrophic for sentiment.
Although the $3.2 billion liquidity fortress ensures financial survival while they rebuild and try again.
True. But assuming success, we immediately shift into execution and timeline risk, which is centered on that ambitious manufacturing ramp. This is where the aggressive delay buffer modeling becomes absolutely critical.
The Midland, Texas facility needs to scale its production aggressively to 6 satellites per month by the end of 2025. Satellites 8 through 19 are already in various stages of production.
This is rapid industrial scaling in the aerospace sector, a domain notorious for complexity, supply chain fragility, and quality control challenges.
And the core metric for commercial viability, the magic number, is achieving 45 to 60 satellites in orbit. That's what's needed to ensure continuous broadband coverage across the target markets of the US, Europe, and Japan.
And the company has guided that they aim to reach this density by the end of 2026.
Let's translate that into reality. This requires a launch cadence of roughly one successful launch every 4 to 6 weeks throughout the entirety of 2026.
That's incredibly aggressive. We have to remind the listener of the necessity of the delay buffer here. Space logistics are constantly subject to external factors, whether global launch vehicle availability, whether they're contracting with SpaceX or ISRO regulatory sign-offs, minor technical faults.
Any slip in that aggressive 4 or 6 week cadence pushes the revenue inflection point further out, burning more of that cash war chest and delaying the realization of the DCF scenario.
And finally, let's look at macroeconomic and cost risk. The year 2025 introduced tariffs that directly impact the CapEx model and the projected ROIC.
The U.S. administration's imposition of broad tariffs, reaching up to 22% on certain electronic and satellite components, directly increases the cost of goods sold.
Yes. While ASTS manufacturers in Texas, they rely on complex international supply chains for critical, specialized parts, solar cells, phased array components, specialized processors.
So what's the financial impact?
Analyst estimates suggest these tariffs could add anywhere from $1.25 million to $2.5 million to the cost of each individual Bluebird satellite.
And if we extrapolate that over the required 60 satellite constellation,
You're looking at a potential CapEx overrun of $75 million to $150 million.
which, while the $3.2 billion liquidity fortress ensures the company can absorb this cost, it is survivable.
It absolutely degrades the long-term return on invested capital. The ROIC takes a hit. It's a significant tangible headwind that makes the eventual utility margin slightly less efficient than originally modeled.
Chapter 7.
Conclusion.
Okay, we've completed the deep dive into the business, the management, the financials, and the risks. Let's summarize our findings through the lens of that Buffett test.
The first pillar, business model understanding, is achievable. It is fundamentally a cell tower utility, but the delivery mechanism, orbital physics, and that aggressive launch cadence introduces high existential technical risk that is difficult to model precisely.
The competitive moat is strong and widening. It's protected by deep IP in the massive phased array, reinforced by that regulatory arbitrage with the SCS framework, and cemented by the high switching costs of MNO partners who are now reliant on the guaranteed 100% coverage. Management is highly aligned, demonstrated by the founder's zero salary commitment. However, this is tempered by the structural risks of the dual-class share system and a documented history of over-optimistic guidance that requires investor skepticism and the use of a delay buffer.
And the margin of safety, non-existent in the traditional financial sense. At the current share price, the market is paying entirely for future growth and the successful execution of the bull case.
Which brings us to the core conclusion. The asymmetric opportunity. This is a venture capital investment packaged in a publicly traded structure carrying binary technical and launch risk.
Exactly. The downside is capped by the massive $3.2 billion cash position plus the intellectual property value, so likely 50% to 70% loss potential in a scenario of prolonged failure. But the upside, the successful creation of a global utility monopoly, offers 5x to 10x potential returns, justified by that $108 billion bull case enterprise value.
Therefore, the sources conclude with a hold speculative buy. This is a highly volatile stock with a beta greater than 2.0, meaning it moves more than twice as fast as the overall market. This position requires conviction and a tolerance for, well, wild price swings.
So what are the actionable insights for you, the learner? When is the critical moment to act?
The immediate critical moment is tied to the December 15th Bluebird 6 launch. If that's successful, technical risk is largely retired, providing an immediate relief rally and allowing the focus to shift purely to execution risk.
And given the volatility in the aggressive timeline and the known history of delays, the recommended entry strategy is twofold. You could accumulate on dips driven by short-term operational stumbles or launch delays using that delay buffer as your friend.
Right. These delays are temporary headline risks that don't affect the long-term viability but often scare away weaker hands.
Or, alternatively, you could wait for the confirmed continuous service revenue inflection point, which analysts anticipate in late 2026 or 2027. Waiting sacrifices much the potential 5x upside, but it fully de-risks the cash flow valuation.
It offers a higher probability of success at a higher price. The investor must choose if they are paying for certainty or paying for maximum asymmetry.
And here's where it gets really interesting, and a final provocative thought for you to consider. Given that AT&T and Verizon, two fierce generational rivals, were willing to put aside competitive differences, invest heavily, and integrate this system into the core of their network architecture, is this the moment the entire terrestrial cellular utility model is officially declared structurally flawed and superseded by space infrastructure?
That's a huge question. If the economics of a cell tower on the ground are permanently invalidated by a massive satellite in the LEO, what does this seismic shift mean for the future valuation of traditional cell tower companies like American Tower or Crown Castle? The disruption here might be sector-wide, affecting traditional telecom infrastructure far beyond just the mobile carriers themselves.
This is a spectacular study in high-risk, high-reward asymmetric investing. The $3.2 billion cash buffer gives them the fuel to reach the destination. The Bluebird 6 launch on December 15th determines if they have the machine that can get them there. The coming months will be critical in deciding the ultimate fate of that $21 billion market cap.
Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
This deep dive was generated based on comprehensive AI research analysis protocol. Remember, this is informational only and not financial advice. Always perform your own diligence and consult a licensed professional before making any investment decisions, particularly concerning highly speculative, high volatility assets like AST SpaceMobile.